Prabhat, let's put the spotlight on Indian markets. Let's talk about valuations first. 2018 has seen its fair share of volatility, both benchmark as well as the broader markets. What's your take on valuations? Because the earning part, while deriving valuation, is just not coming about the way every time the analyst community start the year with.
Okay, let's just say this, that markets have gone up 3%, 4%. What have earnings done? Will they deliver more than that 3% or not? They probably will, right? So markets have gotten cheaper. I mean, you might say that it's underperformed the expectation, but they have gotten cheaper compared to where you started the year from. That is, if you expected the market to deliver, maybe 15-20% on based on 15-20% earnings, they deliver 3% maybe based on a slightly lower sort of earnings estimate or earnings that they'll come through. So I would say that markets, where they started from, have probably gotten cheaper. But having said that, I think they have also taken the brunt of the fact that the earnings didn't deliver as well as people were expecting, and there were some shocks on the way. And they could be external shocks like oil prices going up and down. There was this whole liquidity shock in the Indian market, starting with the NBFC crisis of sorts, or mini crisis I should say. And I think the fact that some fears of slowdown have sort of come through now. But having said that, I think when I was looking at our own strategy, I think market is not very expensive compared to history, or just a bit of tad. And I think if you really look at over a time series period, then it would have gotten slightly cheaper because it's sort of not gone up as much as earnings have gone up.
So what's the right way, in your view, to look at the markets? Price earnings ratio, which gets questioned every now and then, at least last couple of years has been the case, or do you think profit pool as a percentage of GDP perhaps is the right way to look at market at the current juncture, where at one point we are looking at some slowdown in 2019, but the crude oil gains from the collapse will also start flowing into the economy?
So you're looking at profit pool as a percent of GDP, you should be a 10-year investor, because it's a very, very broad measure and is not necessarily a signal for markets or performance in the short term. I mean, when you go back to history, you will see that when it fell to the lowest point, it was the best time to buy. But falling to the lowest point might have happened over 3 to 4 year period, and you would have gone wrong every of those preceding 3 years if you're looking at a percentage of profit profits as a percent of GDP. The P part, I guess, is a derived figure. End of the day, it's derived in many fashions. One is that P should be basically a function of many things, including the growth expectations, including the rates, interest rates that you sort of discount the earnings with, and that keeps changing. The uncertainties in business environment, which of course built in, is a risk premium that you build for the market, and that risk premium also builds in global uncertainties. So I think P is also an inexact science, because it also so it depends on what's happening in the environment. So if the P falls to a dramatically low level, let's say P falls by 20%, and you look at the environment and see everybody bearish, then you can make and conclude that probably it's in the price. But in a neutral sort of zone, then you have to rely more on earnings growth. Because let's say I'm trading at 10 times earnings, which is not the case. Then I can safely say that every bad news is in the price. But when I'm sitting at 15, 16, 17 times earnings, then I can't say that safely. Sure. Therefore, I need to be sure about earnings growth, delivery, to get my returns. So, I think it's
so the current earnings outlook at Nomura, coupled with the way 13 to 18, there was a massive run in our equity, which are strong ones, and then there was a bit of correction. The current construct, do you think next 3 to 5 year picture, one can estimate how probably the case is building for?
So I think there
are politics and other issues as well.
So you look at the overall picture, right? I think the 13 environment was very bad actually. So I think if you look at, it was depressed more or less, because you had a European crisis. Rupee, there was a run on rupee, if you remember that point in time. India was, the weakest fragile five, and from fragile five you went and transition to the strong 5 and stuff like that, then you again became fragile for a while. So I think it's not that, but when you started with fragile 5, the returns, it's counting from low point in the cycle to the high point in the cycle. Like to like basis, returns have been not that great, and rightly so, because the earnings delivery was very, very poor, right? Now, I think if you really think about a very broad sort of picture, right, what is very clear, I guess, at this point in time is that we are seeing a very long-term sort of recovery building up in the investment cycle. And usually when the investment cycle picks up, the growth rates on a structural basis tend to pick up. Leave aside short-term gyrations, which could happen because of monetary policy, because of the sort of NBFC shock we saw, or for example, oil price hike that we saw, unless it happens on a sustainable basis. The view would be that if the investment cycle is picking up, you are structurally moving to higher growth paths. Because investment to GDP ratio, rising investment to GDP ratio leads to higher growth rate structurally. And that basically should mean that you should have a build up in GDP growth, therefore build up in earnings. Compared to past, you should be higher. Then there are one-off factors, like for example, banking sector, which was really reeling under NPAs and was bleeding earnings, because not only was there no credit growth, but whatever credit growth was giving you, whatever earnings, it was being eaten up by the NPA situation. That, there's a consensus that looks very clearly like it from the numbers, that is reversing. And there's a very large sector in the economy. So if you look at the consumer side, well, it's taken a bit of a knock now, but the consumer side never flagged that much. It was still growing at about 10%, let's say. Your volume growth in auto sector or consumer sector was between 5 to 10%. So with inflation, you'll get about that kind of earnings, 12 to 15%, right? So if banks pick up, and the loan growth also seems to be picking up, right? So you should get a reasonable number. Whether that can continue to build on top it depends on so many factors, right? That depends on politics, that depends on global factors. But I think you can safely say that we are sort of coming out of the sort of I would say earnings drought that we've had for the last 5 years, and therefore you should get something out of it in terms of markets.
Let's talk about politics then. Earlier, sometime back when we met, the state election outcome and the way market reacted to it was absolutely surprising. Despite of an unpopular outcome compared what street was estimating, the market rallied a whole lot. And now we are going into the final event in 2019, which will be the general elections. Opinion is divided whether it impacts the market or should we not analyze it much, or yes it does. Where do you stand? And because I see you have done a lot of work on what if analysis, on the way scenarios can pan out and the way market will read it. What are your thoughts there?
So in our view, our strategist, that is our equity team, has put out a report saying that they do expect the NDA to form the next election government. But coming to the more fundamental question first, as to whether politics, and there are divided opinions out there. Politics, some people say politics doesn't affect markets in the long term, simply because we have seen what happened in 2004 and what happened in 2014, change of elections, change of government, etc. But markets don't seem to be correlated, if you really look at it. And my guess is that politics does affect. My view is that it does affect outcomes, but in the long term, because in the short term, changing the direction of the economy is just impossible for politics. And I'll take an example, a case in point. In 2014, for example, when this government came to power, we had many moribund sectors, like you had power sector, which is banking sector, which was heading into trouble, because a lot of the loans they had given were now getting sort of implemented and becoming NPAs as sort of years passed. Many sectors like power, roads, etc. were in deep trouble. Oil sector was bleeding, was hiding part of the deficit. And these things take a long time to correct. But you have probably corrected them. The fiscal deficit was running at 6, now down to close to 3. You had massive inflation problem, done. But all these, essentially, when you correct these problems, are not necessarily creating growth. They're creating more foundation for future growth. So you might have done the right politics, but not good for votes necessarily.